The Federal Reserve, the world's central banking powerhouse. The Federal Reserve, often referred to simply as the Fed, stands as the largest and most influential central bank in the world. Its pivotal role in the global economy cannot be overstated. As the United States serves as the locomotive of economic growth, the Fed's policies have far-reaching implications that extend well beyond American shores. The Fed's global significance. Despite statements from central bankers in other nations asserting their independence from the Fed, the reality is that many of them are inevitably influenced by its decisions. When the Fed signals changes, especially in interest rates, global markets react, demonstrating just how interconnected the world economy has become. As the Fed's leaders project a slowdown in the U.S. job market, they recognize that it's time for monetary policy to adjust. This adjustment is critical not just for the United States, but for the broader global economic landscape. The Fed's policy changes can impact the value of the U.S. dollar, which is regarded as the world's reserve currency, thus affecting economies worldwide. The rise of the dollar. The journey of the dollar to its status as the world's preeminent currency did not happen overnight. It is a reflection of the economic strength of the United States. The value of any currency is heavily tied to the economic conditions within its country. When the U.S. economy flourishes, so too does the dollar. From 2022 to 2023, for example, the Fed raised interest rates to over 5% in an effort to combat inflation, a move mirrored by many central banks around the globe. This tightening of monetary policy made loans more expensive and slowed economic growth, with the intent of curbing rampant inflation. Interest rates and economic dynamics. Higher interest rates typically lead to an appreciation of the dollar. When U.S. interest rates are elevated compared to other countries, capital flows into the U.S. for better returns, thereby strengthening the dollar. Conversely, higher interest rates can also lead to stagnation in wage growth, which helps to prevent wage price spirals that contribute to inflation. The Fed's ability to maintain a strong dollar stems from its long history of managing interest rates effectively based on labor market conditions and inflationary pressures. However, as signs of an economic slowdown emerged in the U.S. by the end of summer 2024, the Fed began contemplating reductions in interest rates. This shift could align U.S. rates closer to those of other central banks, complicating the global economic picture. The impact of rate changes to the Fed's interest rate can significantly disrupt financial markets, including stock trading strategies. A notable instance occurred in early August, when weaker-than-expected payroll data triggered a global market sell-off. The labor market's cooling trends were evident, though job growth remained positive, leading to a slight uptick in the unemployment rate. As investors reacted to the weaker labor data, many abandoned a popular strategy known as the carry trade. In this strategy, investors borrow in a low-yielding currency, like the Japanese yen, to invest in higher-yielding assets in the U.S. However, if the Fed is expected to cut rates more aggressively than anticipated, the dollar may depreciate, leading to unfavorable outcomes for those engaged in carry trades. The Fed's global mandate. While the Federal Reserve's primary mandate focuses on the U.S. economy, its decisions have significant implications for the global financial landscape. The interconnectedness of economies means that shifts in U.S. monetary policy can ripple through international markets. For example, when the Fed tightens financial conditions, emerging markets often feel the impact acutely. However, if the Fed signals the potential for non-recessionary rate cuts, capital flows may reverse, providing a much-needed boost to emerging market policymakers. In many countries that have dollarized their economies, the ramifications of Fed policies are even more pronounced. The U.S. dollar's dominance means that many nations are directly affected by the Fed's actions. underscoring its influence during times of economic uncertainty. China's challenge and the dollar's future. China has developed its own swap lines, extending them to numerous central banks. But many believe this network primarily benefits countries struggling to access international credit markets. The Chinese yuan, or renminbi, currently accounts for about 4.3% of global payments, a figure that is slowly rising but remains significantly lower than the dollar's share. The yuan's growth potential is hampered by a lack of widespread economic incentive to hold it. Recent geopolitical tensions have highlighted the vulnerabilities of dollar dominance, particularly when the currency is weaponized in sanctions against countries like Russia. This situation has prompted some nations to consider alternatives, including central bank digital currencies, CBDCs. However, while the yuan and other currencies may rise in prominence, none are poised to challenge the dollar's supremacy in the near term. A changing landscape. The landscape of global finance is undoubtedly evolving. The share of dollar assets has decreased from about 70% in 2000 to roughly 60% today, indicating a gradual erosion of dollar dominance. Nevertheless, the absence of a clear alternative to the dollar means that it will likely remain the preeminent currency for the foreseeable future. In summary, the Federal Reserve's decisions resonate far beyond the borders of the United States, shaping the dynamics of the global economy. As it navigates economic challenges at home, the Fed will continue to wield significant influence, reminding us of the intricate interconnections that define our world today.